Yes. I mean, obviously, there's always volatility in the prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, and I've got, if you like, a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing. Bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. I mean, the reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. So you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returned back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effect of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 127 years. 25 years, sorry. This is really quite something. So this has significant implications. I mean, we're not just talking about base metals, but if we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very underowned, and it's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article. And I see this continuing. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up. In technical terms, we have what's called a pennant. Some would call it a triangle. And that triangle consists usually of about 5 legs. You go down, up, down, up, down. Now, we're on the final down leg. And this actually coincides with option expiry for the August contract, which is on Monday. So I would expect to see gold drift off a little bit, but we're talking, 1-2% sort of thing. This is not meaningful in the scheme of things. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold. It is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very underowned. I mean, if you look at the other way of looking at this is this is gold, admittedly, but it's estimated that total portfolio assets around the world, global assets, are in the region of, I think the 2023 figure was $270 trillion. If you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager to put raw gold, physical gold, into a portfolio, because he's got to argue the toss with his compliance officer. And, do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. Now, obviously, there is an element of wealth, and a fairly large element of wealth, like say a larger element of wealth than ETFs, privately held as private wealth, not part of, if you like, the sort of regulated investment scene. So it's not recorded, if you like, in ETFs. But nonetheless, I mean, that's very concentrated in Asian hands. We know that. But when it comes to US, when it comes to UK, when it comes to EU, and when it comes to, our friends in Australia and Japan and so on and so forth, gold is very underowned. So if you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And, of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. And so much so that we've even seen this in the trade-weighted index. So, in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies. Yes, I mean, what you say is perfectly natural, because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion, because what you're looking at is credit. It is a credit risk, which depends on your faith in the Fed. And because it's a federal dollar, it's the Fed's dollar. And in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious, because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. So you can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising, for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit. It's a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand that the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. I mean, if you look at it in terms of gold, I mean, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. First of all, there was the devaluation of the dollar. I mean, this is an interesting one because people will say, well, they rose the price of gold from $20.67 up to $35. Really? Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971, driven off Bretton Woods. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. But they were driven off it because basically what was happening is that as long as they fixed the dollar at 35 to the ounce, foreigners were just, saying, well, here, you can have my dollars. I want the gold at that price. Thank you very much. And from about 1947, 8, round about then, America had 22,000 tons of gold in its reserves. And by the time Bretton Woods was suspended, that went down to 9,000 tons. They were clearly running out. And, at the time, they were having to sort of sweep around, see what they could find left in the Fort Knox vaults. And, a lot of it probably wasn't actually deliverable into markets. So that's what happened. We've got, for example, in the UK, as late as 1935, the gold sovereign was worth £1. Today, one sovereign is worth £600. Is it because the sovereign's gone up? No, it's because the pound is rubbish. It's gone down. So this is the message which everybody's got to understand. And this is why the last people who understand it are the people who sort of wake up to the fact that it's not prices going up, but it's the currency going down. And when people actually do understand that, when the general population understands that, the currency is doomed. We are not there yet, but we will go there.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming. Young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.